Financial Planner, follow us on YouTube.
Alasdair, thank you so much for joining us today.
It's nice to be with you. Thank you for asking me.
All right. It's always a pleasure to have you on. And the first topic I'd like to discuss is the recent price action in the precious metal markets. After, quite a bit of a downtrend we saw over the last couple weeks, this week, gold and silver are up a bit. Gold is retesting 1,300 and silver is back above 17. What do you think is driving the price?
I think the recent price action is encouraging. Bear in mind that the dollar price of gold retraced a Fibonacci number. It was 61.8%. Now, I don't know if that matters anything at all, but I throw it in for what it's worth. The other side of it is that the recent fall in the price of gold has pretty well matched the bounce in the dollar. It turned on September the 7th. That was the day when we had the highest price in gold, and it sort of went up towards 1350, and that was the day that the dollar bottomed out. So in a sense, I think what we have seen is a fairly natural reaction, given that there's been a technical correction in the dollar.
Now, where do you see the dollar continuing to bounce and precious metals to continue to decline, or where do you see precious metals going into the future?
Well, I'm a bear of the dollar, and I think I've got very good reasons. If you look at the global economy, the real story, growth story, is in Asia, driven really by China. China is spending huge amounts of money on improving infrastructure, both in China itself and also with the OBR, the One Belt, One Road project. You've got both the land version and the maritime version. There are infrastructure projects the whole way across Asia connected with that. We've got a big meeting, if you like, in China amongst the bigwigs, and that's next week. So a lot of this will be, I think it doesn't need to be confirmed so much. It's just the appointments of individuals more than anything else. But I think what tends to happen is that the actual spending on these infrastructure projects tends to pause a bit ahead of these very, very big meetings, Politburo type meetings. And consequently, I would expect to see an acceleration of interest in what China's doing from maybe the next 2 weeks onwards. So running up towards the end of the year, I can see the Chinese economy being reassessed. I can see that the impact on Europe is to reassess the prospects for the Eurozone economy, the British economy, the Japanese economy. I've missed one out. I wonder why. America. The American economy has got nothing to do with this at all. The Americans have effectively isolated themselves from the big growth story that's going on in Asia. And so I think that the problem for the dollar is that you're going to see the rise in commodity prices measured in dollars. You're going to have a stagnating economy. I don't think it's going to go backwards. I think the economy will grow, but it'll just grow slowly. And the combination of a weakening currency and slow growth in the United States will lead to inflation. And I think that price inflation is going to be very much a feature of the commentary, really quite early on in the new year. So for those reasons, I'm a bear of the dollar. And the other thing is that on the geopolitical scene, I don't think we've seen the fact that America walked away from Syria and the consequences of that, they haven't really been fully worked through yet. It was a very, very sudden decision back in July for America to decide to withdraw its subversive activities, supporting rebels and so on. That was back in July. Effectively, it has handed the Middle East to Russia on a plate. We've even seen last week King Salman going to Moscow, doing the normal thing of signing a few deals for military hardware and so on. Now, this is a complete volte-face from the previous situation where in 1973 onwards, Saudi Arabia agreed, this was President Nixon and Kissinger, got an agreement from the Saudis to do all their oil pricing in dollars and to invest in US Treasuries and to recycle in the form of deposits their surplus cash through in dollars, so effectively through the American banks. That is now changing, and I think there was a story on I think CNBC this morning, where some economists who seem to be pretty well informed reckoned that Saudi Arabia will probably come to an agreement with China to supply oil priced in yuan rather than in dollars. Now that really is a first. The effect of all this is to reduce the demand for the dollar internationally, and therefore you're going to see dollars going back to America, driving the price down. They will be sold for other currencies. So for all those reasons, I'm actually quite bearish for the dollar. And the other side of that coin, obviously, is if the dollar is going down, then the gold price will tend to rise.
Definitely. And I'd like to talk more about the Chinese trading oil in yuan. They're planning on introducing a oil futures contract denominated in yuan. Can you expand on and explain a little bit more about this and how this will impact the petrodollar?
Yes, certainly. It has actually been planned for some considerable time to introduce an oil contract priced in yuan. I think that the first indication we had of this was way back in 2012. When they were talking about a contract in sulfur-heavy oil, because that was the oil that China used. And they were talking about contract either in dollars or in yuan at the oil seller's choice. That has now obviously changed somewhat. This contract has been delayed and delayed. In 2014, we were told that the government had approved it. This was by the chairman of the Shanghai Futures Exchange. And still nothing happened. But there was an article by a journalist who actually contacted me to discuss this, a journalist who had his article published in the Nikkei Asia Review, and the journalist was called Damon Evans, and I was quoted in that article that this oil contract is a mechanism which is likely to appeal to oil producers that prefer to avoid using dollars and are not ready to accept that being paid in yuan for oil sales to China is a good idea either. In other words, what these guys can do, I mean, countries like Iran or Venezuela, who are effectively frozen out of the dollar markets, they can sell their oil for yuan and cover the sales forward in the futures market and match it with the futures contract in yuan into gold, and then stand for delivery for the gold. So this way, it is quite possible that given the demise of the dollar as a petrocurrency, that significant amounts of money could seek to flow from sales of commodities and particularly energy into physical gold. Now, one of the misunderstandings in all the commentary that has followed Damon Evans' article was that China would be supplying the gold. That is not the case. China will not supply any gold. The gold will have to be sourced in the markets. So if you look, for example, at the quantities that are likely to be involved, China imports roughly 8 to 8.5 million barrels a day. That's about $150 billion worth of oil. And if you take about a third of that, say, if that's converted into gold, you're talking about 1,200 tons at current prices. There isn't 1,200 tons available in the market without the price rising substantially. And if the price starts rising substantially, it is quite possible that the gold won't be there either, because people who are underweight in gold would probably seek to correct that position once they see the gold price moving into a bullish phase. So this could be quite a big story. We'll have to see how it pans out. It is quite possible, of course, that none of the oil producers decide to take the, if you like, the opportunity to swap yuan for oil into physical gold across the futures exchanges. That is quite possible. But I think, however, there is bound to be the temptation there, and I would have thought that it would certainly absorb any gold that might come onto the market.
Definitely. And if you could clarify this a little bit more, because I know we've talked about this on the show, and we were talking before the interview has actually. maybe calling this oil's futures contract gold-backed isn't technically accurate. Can you explain a little bit more about that?
No, it's not at all accurate, because what we're talking about is an oil contract priced in yuan. And at the moment, there is a yuan contract for gold. Now, the yuan contract for gold actually is the main liquid one is in Hong Kong, not in Shanghai. There is also another contract in Dubai, but that again is partly sponsored, believe it or not, by the Chinese government. So what the Chinese government are doing with the gold contracts is they are moving them, it appears that they're moving them offshore from mainland China. They're using Hong Kong, they're using Dubai, where oil sales are likely to come from. So that's one side of it. The other side of it, of course, is the oil for yuan contract. They're two completely separate contracts. It's quite possible that if they want to sell oil for yuan, they can convert those yuan into silver or copper, or it really doesn't matter. But they are more likely, if they're going to go for anything on the futures exchanges, perhaps to go for gold.
All right. Well, before we let you go, I wanted to touch on one last subject, Alasdair, and that is about interest rates. And you recently wrote an article about how you believe central banks across the globe are preparing to increase interest rates. Can you explain why you think this, and also what an impact would increasing interest rates have on the U.S. dollar?
Well, I think I've sort of touched on this subject earlier in this interview. The thing that is driving the global economy is what China is doing. We now have, between China and Europe, trains running regularly. I mean, there are a number of trains every day. These are goods trains with 40-foot containers on them going back and forth. So that Mercedes, for example, who have a factory in Stuttgart, can get a brand new car on the showroom in Beijing in 15 days. That's the current situation. Equally, the other way, a manufacturer like Zanussi, which is an Italian white goods manufacturer, they have all their factories in China. They can ship their white goods into the European markets, again, within 15 days. Now, this compares with the time taken to get from a Chinese port to Amsterdam. That takes just over 30 days. So you can see that the cutting down of the transit time is generating quite a lot of economic activity. This means that from China's expansion, we have it's driving the Eurozone economy. It's also driving the British economy. It's also driving the Japanese economy, the South Korean economy, and all those economies in Southeast Asia. There is a big growth story going on, and we are at the beginning of it. And that is why interest rates are going to have to rise, particularly in the Eurozone, where they still have negative rates for the banks trying to deposit money at the ECB. They've still got an asset purchase program of 60 billion euros a month. The Japanese have got negative interest rates. Going back to Europe, if you look at the German 2-year Schacht bond, that is yielding a minus 0.6 or 0.7%, which is absolutely crazy for an economy that's actually growing. The German economy is growing quite rapidly, by the way. So that is why interest rates have got to rise. It's as simple as that. America has been left out of this. America has sort of become really quite isolationist in terms of her trade approach. And consequently, none of this growth really is going to benefit America. This is not to say that America is not going to have, it's going to have no growth. No, I think it will have some growth, but it will be really pretty subdued. And the fact that you have very subdued growth in one area compared with other areas, and the potential for interest rates to rise is less, basically means that your currency is going to be weak relative to the other currencies. And I think that is what we're going to see as far as the dollar is concerned. So that is why interest rates are going to be rising around the world. I think the Fed will have to raise interest rates, not so much because they will have an overheating economy, but as much as anything because they will have a weakening dollar, and they will need to try and protect the dollar, and that means higher interest rates. Higher commodity prices measured in dollars is going to be a feature, I think, of 2018. And that again means that you've got potentially inflation problems beginning in the first half of next year. I think we're going to have the prospect of inflation all around the world, but it's probably going to look worse given the stagnating economy in America.
All right, now moving on here to viewers' questions. This viewer is wanting to know about your thoughts on, a lot of people are call gold a barbaric relic, that's thrown around a lot, that saying, and how it's no longer a genuine asset in the 21st century, and that cryptocurrencies are the new kids on the block. What is your response to that perspective?
Well, what a lovely question. Okay, the first thing I would say is that just to correct slightly, I think it was Lord Keynes who said that the gold standard was a barbaric relic, not gold. So we just be pedantic and correct that one a little bit. Okay, gold versus crypto. The first thing I would say is that cryptocurrencies are not money. There is absolutely no way they are money. Of course, you can have someone who will say, I will take payment in cryptocurrencies, Bitcoin or Ethereum or whatever. But that is not the same thing as them being money. For them to be money, you have to have a wide recognition that it is money. You also have to have stability of price. And the third thing you have to have, and this is probably most important, is a history of the money, or if something that claims to be money, actually being exchanged, used as money over previous times. So that this is called the regression theorem. The regression theorem. This is something that von Mises particularly emphasized. The reason that we know a dollar is worth what it is today, what it will purchase today, is that we knew what it purchased yesterday. And yesterday we knew what it purchased the day before. And if you go all the way back through history, that gives you, if you like, that sort of unbroken confidence that you can use the dollar as money, and the dollar will be accepted by almost anyone that you're likely to deal with if you're an American citizen. Indeed, if you're a world citizen, it's quite useful dealing where you've got dollars and other currency as well. It is universally accepted and understood to be money. This is not the case of cryptocurrencies. Cryptocurrencies are purely a speculative bubble. Now, I'm not decrying it for that. Just hear me out. The point about cryptocurrencies is that they're rather like tulips without the bulbs, if you like. And they're being driven by this human emotion. Now, we know that one of the characteristics that makes it so appealing is the limited supply. And of course, everybody turns around and says, well, we know it's getting more and more expensive to mine Bitcoin, so the supply is limited, and there are more and more people looking to buy it. So one way and another, it's got to go up. I quite agree. I absolutely agree with that. But don't tell me it's money. So gold is completely different. Gold has a history of being money, which goes back, since the dawn of exchange, if you like, 5,000 years, 10,000 years, whatever figure you like to pluck out of the air. And indeed, all the paper currencies, the government currencies we have today, basically went back to their exchange in gold. They were a gold substitute. The reason that you accepted, dollars, say in the year 1900, was that you knew that if you went along to your bank, you could exchange those paper dollars for physical gold. And when the Fed system came in, it was exactly the same, except it was done on a federal basis, with the Fed basically coordinating it through regional offices. That was stopped, as we know, back in 1930, was it 31, 33, I think it was. Ever since then, it's been the whole thing has been sort of eroded and eroded and eroded. And if you think about the gold, which the Fed, not the Fed rather, it's the Treasury now, the Treasury has today, that was current Americans' great-grandfathers' gold. They took their gold along to the bank and put it in the bank for safekeeping and were issued with a receipt. Now, instead of great-great-grandfather actually being given back his gold, or his son or his grandson being given back that gold. What's happened is that the bank has just taken that gold and moved it along a bit. And it moved it along, first of all, to bigger banks and then into the federal banks. And the Fed, guess what, then moved it into the US Treasury. So that what has happened is that the real money, the only real money that actually exists in America, has now been stolen by the government. I use that word, it's maybe a bit emotional, but that in effect is what has happened. Legally, it's legalized theft, if you like, of real money. And instead, they issue huge quantities of paper money, and they license the banks to issue even larger quantities of credit. So, the real money, if you like, the government has sort of has stolen off its citizens and issued fake receipts to the citizens. So, but even though that is the case, as having dollars in your pocket, that you can spend those dollars to buy things day to day. Why? Because the origin of the dollar was that it was exchangeable for gold. There is no way that you get that sort of credibility, which money requires, in any of the the cryptocurrencies.
Here's one question about precious metals. They're wanting to know, when you store gold with gold money, is the gold really outside the banking system?
Yes, it is. It is stored in a vault of your choice. I think we've got something like 11 vaults around the world, which you can choose from. And it is in your name. So if for any reason gold money, sort of has insolvency or whatever, then it is definitely your property. It is audited as such every quarter. There is absolutely no doubt as to the ownership of the gold, which we effectively act as custodians for. And it is obviously out of the banking system, being in vaults.
All right. Well, Alasdair MacLeod, thank you so much for joining us today and sharing your insights. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
I don't think any. I think your viewers' questions were really, quite good. So I'd like to leave it at that. But you'll find me online at goldmoney.com. And if you go onto the site, you'll find that there is a research tab. And under there, I write an insight article, which is published once a week on Thursdays. So there's one going out later this afternoon. And I also do a market report on Fridays, which if your viewers have an interest in precious metals, they might like to read from time to time.
All right. Once again, thank you so much for your time today.
That's my pleasure.